Hi, it's John Kelly. In this module, we are going to discuss Section 540 Revised, Auditing Accounting Estimates. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, this section's effective date is it's effective for periods beginning on or after December the 15th, 2019. Now, this is written for companies that have a 52 or 53 week year. If you wrote it periods beginning on or after December 31st, someone who had a December 28th, 2019 year end wouldn't be caught for yet another year. So what that means is normally this will be applied in audits for years ending December 31st, 2020. So we have a while before we have to start applying this. Now, important to pay attention to paragraph 2. Paragraph 2 says that estimates vary widely, and it notes that estimates contain estimation uncertainty, which causes estimation uncertainty. When uncertainty is low, paragraph 3 notes that procedures need not be effective. And probably that's what's going to be the case most of the time. Allowance for doubtful accounts, inventory obsolescence, depreciation of fixed assets, amortization of fixed assets. Uncertainty will be low and the procedures need not be extensive. The balance of the section seems to be written for what you do if risk of material misstatement is high or significant. And I'm going to say a couple of times through this module that if risk of material misstatement is high or significant, you're probably going to need to sit down and write a specifically tailored audit program for that estimate. And in that case, this section will be quite helpful, and you need to follow through, take the various hints on how you might do risk assessment procedures and what you might do and what your audit approach might be. But otherwise, we need to remember that probably procedures need not be extensive. Now, the other thing about estimates is, of course, they're not right. And I have a couple of quotes from two Canadian public companies, and you'll see basically they're identical. Revisions to accounting estimates are recognized in the period in which the estimates are revised and any future periods. And actual results could differ from these estimates. That's the Empire Company. Bank of Nova Scotia basically uses identical wording. The first sentence is identical, except they talk about years ending as opposed to periods ending. And actual results could differ is the same. They apply a little qualifier. While management tries its best, actual results could and will differ. Now, what that means is even if the estimates are quote-unquote wrong, the next year they're found to be wrong, the financial statements for last year are right. And that comes from IAS 8, paragraph 36, that says estimates are fixed in a future period. So the estimate being wrong, as long as it was reasonably carefully made, it's correct and fixed in the future period, or rather the financial statements are correct, even though the estimate subsequently turns out to be wrong. And remember, we now warn everyone in the report, an audit is not a guarantee that material misstatements will be detected. That's the new sentence in the new audit report. So users should be pretty clear that if it's an accounting estimate, and if we have disclosed it appropriately, that it's correct, at least defined to be correct, and will be fixed in the following period. Now, what you will find if you read public company financial statements, the notes tend to detail every possible source of uncertainty. They describe in general terms, normally, sometimes more specific, how the estimate is made. Perhaps, say you're using Black-Scholes to value something, they will describe the variables used. We have this interest rate. We base this interest rate on this theory, prime plus something or other. And maybe then that'll allow you to reperform the math. So if you don't like the interest rate that management used, you think it should be different, you as a user can redo the math and come to your own conclusion as to how that option, for instance, should have been valued. So even if the estimate could vary a lot, if the disclosure properly states this, and you will see from looking at public company financial statements that they are doing that all the time, virtually sometimes every item in the financial statements, there's a warning that says it could be wrong. So is it going to be ever the case that risk of material misstatement is high or significant, or is it more or less always going to be less than that, and that the issue for the auditor is not the math and the number, but is the disclosure okay? And so given that the disclosure is okay, we've described how it was done, we've described the math, we've disclosed the variables, or rather the client has, and the auditor has audited that, perhaps risk of material misstatement will only very occasionally be high. Now the first thing that this section does differently, and it's really not different, this change is proposed in the exposure draft for section 315, but it says we should separately assess inherent risk and control risk. So this is really not unique to accounting estimates. It's going to be required for everything shortly. Currently, we do a combined assessment of inherent and control risk. So it's kind of like you do your risk assessment procedures, you do the interim audit, you do your control testing, your walkthroughs, and at the end of that you say, how much more work do I need to do? How much substantive testing do I need to do at year end, and specify that? And that's kind of the logic it takes. That makes sense. I think it makes more sense to separately assess inherent and control risk because they're really quite different. And I actually find it confusing when I try to explain it to people or teach it to people. And just to go off on an aside here, the differences between inherent control and detection risk. Inherent risk is an assessment, and it's based on our understanding. It's based on risk assessment procedures. So risk assessment procedures in an audit are very important. And maybe they're not hard. This is partner level or perhaps senior manager level, understanding of the client, some very rough analytical procedures this year to last year, talking to the client, seeing what has changed, and concluding whether any of the financial statement items could be materially misstated. Now, does that process, do those risk assessment procedures, do those analytical procedures that we do as part of planning, do they produce any evidence? No. But it defines how much evidence is needed. If inherent risk is low, we need a lower amount of evidence, whether obtained by control testing or substantive testing. If inherent risk is higher, we need more. Could the assessment of inherent risk be wrong? Yes. That is the risk in doing an audit. We're going to try our best with our risk assessment procedures, but if we assess inherent risk based on well-done risk assessment procedures as low, we're going to do little audit work, and we're probably not going to find the problem if there is one. Control risk and detection risk, I think, are kind of the same. We assess them in the plan, and we support our assessment by testing. Control risk we support by assessing testing controls. Substantive risk or detection risk we assess by doing or support by doing substantive procedures, including analytical procedures. Does control risk and detection risk produce evidence? Yes, based on our extensive testing, both of them produce evidence. And can they be wrong? No, unless our testing is somehow wrong, unless we have non-sampling risk or something. They can't be wrong. They will support our assessed level of inherent risk. The assessed level of inherent risk could be wrong. So control risk and detection risk are the way I look at it. They're the same, and they differ from inherent risk, and they're also choices. We're going to decide, hey, we're doing this audit by doing nothing but substantive testing. Or, hey, sometimes you have to do control testing, completeness, for instance, sometimes no practical way around it. Substantive testing, we always have to do some kind of substantive testing, but an analytical procedure can be that substantive test. So I like this change. The characteristics of the new section, lots of it is the same as before, particularly if inherent risk is other than significant. It's virtually identical to before. The other thing they do, and I wish they wouldn't do it because it kind of affects clarity, but they repeat many other standards. So they repeat particularly 315 and 330 and say, as required by 315, and here's the list of all the things that 315 requires you to do. Okay, that's the style. The other thing is we have to ask the question, will auditing estimates harder improve them? So if an accounting estimate is really uncertain and possibly going to be found to be wrong in a future period, will doing more audit procedures make it a better estimate? And the answer is in A48, paragraph section 200, A48, it was A46. And it basically says that the variability in accounting estimates cannot be eliminated by doing more work. And then says, for example, this is often the case with respect to certain accounting estimates. So auditing accounting estimates harder doesn't make them better, and we need to remember that. So regardless of complexity, if estimation uncertainty information is disclosed, what's the risk? Or is the risk only the failure to disclose enough? And that's pretty simple to audit, actually. If we've got a complicated estimate, we just need to make sure that our audit is going to say, well, yeah, it's a complicated estimate, but is the disclosure okay? Does it disclose the uncertainty of that estimate? Does it disclose how it was made? Does it disclose the variables? And if we've done that, perhaps risk of material misstatement is not high. That's our conclusion. And you will find many companies now disclosing virtually every number in the financial statement could be wrong with an associated description of estimation uncertainty. So the detailed paragraphs. Paragraph 13, similar to before, it's pretty much the same as old paragraph 8. It recites the requirements of 315 and provides rather a long list of things we might do. But it notes that this is done to the extent necessary. So I don't think that really is any change, again, unless risk of material misstatement is really high. Paragraph 14 requires a retrospective review, which is now required by paragraph 9. So that's no change. Paragraph 15, same as old paragraph 14, determine if special skills are needed on the audit team. Paragraph 16, assess risk of material misstatement and separately assess inherent and control risk and detection risk. Similar to old paragraph 10, there is a longer list of items to take into account when assessing risk of material misstatement. And again, I think that's useful if risk of material misstatement is high, but there's no specific documentation requirement for this. So again, I think this paragraph is useful if you are developing an audit program for higher risk of material misstatement. You are to assess if risk of material misstatement is significant. That's the same as old paragraph 11. It adds understand controls relevant. That's always been required by 315. The other thing is, if we're talking an accounting estimate, it's very likely that there will be no internal controls, or at least no internal controls that we can use in an audit. Not like we find internal controls that arise because segregation of duties in, say, sales receivables receipts. So most likely that there are none. Or if there are controls, they may be that somebody did the estimate and somebody approved it. That's not the kind of control, if risk of material misstatement was significant, that I would really want to draw a lot of evidence from. So there may be no controls, or if there are, they may not be something that we can use to turn into audit evidence. Responses to risk and material misstatement are given in paragraph 18. We are given 3 choices: use subsequent events, and that probably, if we're doing a large public company who has to get their financial statements out very shortly after year end, not going to be that helpful because the subsequent events period is not long. For doing a private company that's got 5 or 6 months to get their financial statements out, then perhaps subsequent events will be helpful. 2 other choices: test management's estimate or develop our own estimate. Now that is the same as old paragraph 13, and indeed, what else would you do? I don't think there are any other choices. So it looks like a restrictive list, but really it describes basically the only 3 things we could do. The other thing that paragraph 18 now says, do more work if risk and material misstatement is higher, and of course that's what we do. Test controls, if you use them, of course, it repeats section 330. And as I said before, controls are perhaps unlikely to be useful or available. And again, test controls if we use them. If there's a significant risk, test the controls if you use them. And of course, if you are doing only substandard procedures and risk of material misstatement is higher or significant, include tests of details. And I think it would be kind of hard to avoid that. It means that you can't use a simple analytical procedure, and they say that actually. You can't address a significant risk of material misstatement with only analytical procedures. Now, perhaps you've got a analytical procedure that is in fact a test of details, something like regression analysis. And I had a client who was involved with a client once, sold natural gas. And we decided that we could replace all of our testing of the revenue receivable receipt system pretty much with a single regression analysis based on degree days Celsius. And that was a very, very powerful, very, very exact analytical type procedure that constituted a test of details. One of the suggestions they have is redo the math, and be careful with that, because if you're doing an audit by redoing the accounting, you're at some risk that you're going to miss the forest for the trees. So standing back from redoing all the accounting, and that's not necessarily efficient, and it's a lot of work and it's boring. So standing back and finding a better way to do the audit and redoing the math is perhaps not a bad idea, particularly in something like an accounting estimate. If you use subsequent events, evaluate if you have obtained sufficient appropriate evidence, and of course you would do that, and of course that's now required elsewhere. If you're testing how management did it, you test how management did it. That could be simple, and be careful with that, as I said before. There is a very detailed list in paragraph 23. Says assess whether the method selected is okay, and I think that's implicit elsewhere. Evaluate management bias, and we're going to find bias in this section mentioned about 10 times. It's already addressed in other sections of professional standards, so that's not anything new. Test if the method applied is okay and the math is okay, and that's implicit, I think, in other sections. And if risk of material misstatement is lower, analytical procedures would do. If we are testing the accounting estimate of amortization, perhaps a very simple analytical procedure will do it, and we don't need to reperform all of management's math, which would take a long time and be very boring and might miss the forest for the trees. If it's complex, that would affect the audit program, and indeed, as I've said before, if risk of material misstatement is higher, think you need to write a specific audit program for the specific issue. So this stuff, I think, is either obvious, implicit elsewhere, or for the details of an audit program. Sounds to me like the standard setters are trying to write an audit program for a client they know nothing about. We know about the client they don't. Testing significant assumptions, how to do that, paragraph 24. Test whether the significant assumptions are appropriate, and of course may all be not not applicable if there are no significant assumptions. That's, I think, implicit. Bias, again, always and elsewhere. Whether the assumptions are consistent, that's implicit. And again, if we need to write an audit program, we really need to write a detailed audit program. And does management intend to carry out the things they say they intend to carry out? And that should be in the rep letter. Testing the data, is the data appropriate? That's implicit. Bias, again. Whether the data is relevant and reliable, I think that's implicit. And whether management understands the data, and again we get to a place where this should be in an audit program for risk of material misstatement being high or significant. Testing management's point estimate, address whether management understands estimation uncertainty and has an appropriate estimate and disclosure. Think again that's implicit in current standards. Don't need this section to tell us that. If management hasn't done a good job, we have to be careful in this section. So if we have an estimate and management has done it, in our opinion, not terribly well, the first thing we might do is ask management to do better. And indeed, given that we're not supposed to be making the estimate and we're not supposed to be doing management's job for them, we might do more work, but I don't know how practical that is. That seems to imply that we should make the estimate and tell management to record it, and of course we can't and we shouldn't. So I think we're stuck with, unless it's it's depreciation or amortization, and management has just done it very quickly and kind of sloppily, but we look at it and it's an immaterial number and it's close enough. Perhaps we can accept that. But that might be something you want to put in the internal control memo. You might want to report to those charged with governance. So be careful with doing your own work if management hasn't done it well enough in the first place. Point estimate repeats 23 to 25 with respect to a point estimate. If we're doing a range, there are two suggestions, and they both basically reduce down to obtain sufficient appropriate audit evidence. Paragraph 30, follow section 500 and follow the rules on using management's expert. So that's just repeating something required elsewhere. Audit the disclosure, paragraph 31, both about the estimate and estimation uncertainty. And of course, this might be the most important thing. So checking the estimate is probably not as important as checking the disclosure. And I've said that before. Checking the disclosure is really, really important. Bias, have a whole paragraph about it now. It's been mentioned before and it's otherwise required. Evaluate the evidence, paragraph 33. That just restates section 330. How to evaluate the evidence. You do it by considering all the evidence, and it's just restating what is already required in standards. Determine if the estimate is misstated. That's the same as paragraph 18 now, and it restates section 450. Evaluate the disclosure again. It's evident from the section that the disclosure is really important. The rep letter, this is probably the single biggest change. There is a longer list than we now have perhaps in a rep letter. And look at paragraph A145, it basically has the needed text. This is something, now we don't have to do this, I suppose, until an audit we do in February of 2021 on a December 2020 year end, but I don't see any harm in changing the representation letter now and including all the additional detail that's suggested in paragraph A145. So given that they're kind enough to make this suggestion, I think I would start with this as soon as I can. Communication, restate section 260 and 265. Maybe implicit in the financial statements anyway. We've got this detailed description of how estimates are made. Documentation, 5 things. key elements of the understanding of internal control, and that's not new because it's now required by 315. Linkage, not new, required by 330.28b. What you did if management was wrong, of course. Indicators of bias, required by 540 now and elsewhere. And significant audit judgments now required. So there's nothing particularly that we need to remind ourselves to document here. We should already be doing all this. So is this new or not? And professional standards now tend to be rewritten. As they write a standard like this, they tend to rewrite all the other standards into the section. So they've done that. I think it results in a bit of a lack of clarity because it makes it sound like these are things that we otherwise didn't have to do, and we only have to do them because of new section 540, and that's of course not true. So there's really nothing new in this section, though, as I've said a couple of times, I think this section will be most useful in the rare circumstances when we consider risk of material misstatement to be either high or significant, and we want to write an audit program, and I think we should want to write an audit program in that circumstance. But don't overcomplicate it for other accounting estimates that we're now appropriately addressing and are of low risk of material misstatement. And don't think this is all new, because it's not, pretty much. So it's not new. As I said, the most significant thing is start now. New rep letter, get the wording from that section, and start using those new words in the rep letter now. Everything else is pretty much the same, repeated, or in much greater detail than it was before. So, thanks for listening.